Hey everyone, and welcome. If you're an investor trying to really get your head around the banking sector, well, you are in exactly the right place. Today, we're going to pull back the curtain on how banks actually work and give you the first, most critical tools you need to analyze them.
So, here's what we've got on tap. We're going to start by looking at how banking became the digital powerhouse it is today. Then, we'll talk about why it's so critical to the economy. After that, we'll map out the structure of the industry right here in India. And then, we get to the really juicy stuff. The two most important metrics for judging a bank's health: how it makes its money and how big its safety net is.
All right, let's dive right in. To really understand banking today, you have to appreciate just how insane its transformation has been. It went from being this very physical, in-person thing to something that literally lives in your pocket.
I'm sure many of us remember the days of actually going to a bank branch, standing in line just to get a passbook updated. It felt like a whole event. But fast forward to now, and you can do everything. Open an account, send money, even get a loan approved. Instantly, from your couch, on an app. The difference is just night and day.
And it's because of this massive, fundamental shift that it's totally fair to call banking a real pioneer. Think about it. They had to solve huge problems like digital identity, security, and instant transactions at a massive scale way before most other industries even thought about it. So this super digital industry isn't just about convenience for us. Now, it's much bigger than that. It's basically the circulatory system of our entire economy. A healthy banking sector means a healthy nation, financially speaking.
And here's the key takeaway. Banking activity is like a powerful barometer for the economy. If businesses are feeling good, they borrow money to expand, and banks do really well. If they're nervous and pulling back, guess who feels it first? The banks. So by analyzing a bank, you're getting a real-time pulse check on the entire economy.
And this just shows how deeply tangled banks are in every part of our financial lives. From our personal savings accounts and home loans, all the way up to huge corporate credit lines and international trade, pretty much every single rupee flows through the banking system, and it's all happening under the watchful eye of the RBI.
So, what does this incredibly important sector actually look like here in India? It's not just one giant blob, it's a really well-defined, layered system. Let's break down that landscape.
Okay, so at the very top, you've got the boss, the Reserve Bank of India. They set the rules for everybody. Then you have different kinds of banks for different jobs. But for us as investors, the group we really want to zoom in on is step 2, the scheduled commercial banks. These are the big names you see listed on the stock market.
And just to give you an idea of the scale we're talking about, it's staggering. Just look at these numbers from mid-2023. We're talking about nearly 160,000 branches and over 200 crore, that's 2 billion savings accounts. The sheer volume and reach of the Indian banking network is just massive.
Now, all this activity is heavily regulated, especially after the 2008 global financial crisis. That event led to a global rulebook for banks called the Basel III norms. And here's the interesting part. For us as analysts, this heavy regulation is actually a huge advantage. Because the rules are so strict, banks are forced to be incredibly transparent and report a ton of standardized data every single quarter. It makes our job of comparing them so much easier.
All right, let's get to the heart of it. How does a bank, a business that only deals in money, actually make money? Well, it all boils down to a surprisingly simple concept.
The most basic way of bank profits is through something called net interest income, or NII. Just think about it this way. The bank earns interest on all the loans it gives out, right? Home loans, car loans, you name it. But at the same time, it has to pay interest to people like us on our savings accounts and fixed deposits. The difference between the interest it collects and the interest it pays out, that's its core profit.
Let's look at a real example with ICICI Bank. In a given quarter, they earned over 34,000 crores in interest. They paid out about 14,500 crores to their depositors. You do the simple math, and the difference, nearly 20,000 crores, is their net interest income. It's the profit they made just by being a bank.
Okay, so NII is a big, absolute number, but it doesn't tell the whole story. To get real context, we need net interest margin, or NIM. What NIM does is it takes that NII and turns it into a percentage. It tells us how profitable a bank is relative to the size of its loan book. It's a fantastic measure of a bank's efficiency.
So, for you as an investor, this is what you really need to watch. A widening or growing NIM is a fantastic sign. It means the bank is becoming more profitable. But on the flip side, if you see a bank's NIM shrinking quarter after quarter,
That's a potential red flag. It might mean they're facing tough competition or that changing interest rates are squeezing their profits. And to give you a handy tool, here's a benchmark. A top rating agency expected the average NIM for the entire industry to be around 3.45% for the 2024 financial year. So when you're looking at a bank, you can ask, is its NIM higher or lower than the average? It gives you immediate context.
Now, making a profit is one half of the story. The other, equally crucial half, is making sure the bank is safe and stable enough to survive a crisis. This is where we need to look at its safety net.
And that safety net is measured by the Capital Adequacy Ratio, or CAR. Simply put, this ratio tells you how much of a capital cushion a bank has to absorb unexpected losses, like a bunch of bad loans, without going bankrupt. It is one of the most important numbers for assessing a bank's risk. You might be asking, okay, but why all this focus on capital? Why is this cushion so important? Well, it's because of the way banking works. Even a small loss can create a really big ripple effect. Let me walk you through a quick example to show you what I mean.
Check out how this plays out. A bank's own money, its capital, is the foundation for all of its lending. When a loan goes bad, that loss doesn't just vanish. It gets deducted directly from the bank's capital. And when the capital base shrinks, so does the bank's ability to give out new loans. It directly hurts their ability to operate and grow.
Because this is so incredibly important, the RBI is very, very strict about it. They mandate that all banks have to maintain a minimum total CAR of 9%. And get this, that's actually higher than the global rule of 8%, which just shows how cautious and prudent our system is designed to be.
And this right here is what a healthy number looks like in the wild. ICICI Bank had a CAR of over 18%. That's literally double the minimum requirement. As an investor, when you see a number that high, it gives you a huge amount of confidence that the bank has a massive safety buffer to handle whatever gets thrown at it. So there you have it. Just by understanding two key metrics, net interest margin for profitability and the capital adequacy ratio for safety, you've already built a really powerful foundation for analyzing any bank. But the story isn't quite finished. The next obvious question is, okay, the bank is profitable and safe, but how good are the loans it's actually making? That's a question of asset quality, and it's the critical next piece of the puzzle that we'll be tackling in part 2 of this explainer.